Good afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital. I'm excited to be joined with longtime industry friend and colleague Pierre Raval, the Chief Financial Officer of FrontView REIT, also based here in Dallas, Texas, by random chance. And we have a little presentation up on the screen here. I'll hop through a couple of slides. We'll turn off the presentation. We'll have a dialogue. We'll refer back to the slides accordingly. But for those that don't know, FrontView is a net lease REIT. They have properties, as they state, are on high traffic roads that are highly visible to consumers, a real estate of first approach. At the end of the third quarter, 307 properties across 37 states, and then a range of business-oriented services and tenants. We'll go through a whole list, but here's a little sample of their type of tenants. Some quarterly highlights: they did acquire 3 properties in the quarter. Just under a 7.5% cap rate. They did sell 15 properties, a 98% occupancy, a 6.3% dividend yield. They did raise their guidance and they established 26 guidance. One more interesting note here, and we'll get into it, was the transaction with, is it pronounced Maywin? Is that how they pronounce it?
Yep.
With Maywin Capital Partners in a big convertible preferred offering. And Charles Fitzgerald, longtime REIT industry veteran, mutual friend of both Pierre and myself as well, being added to the board of directors. Would love to hear their thoughts about what's going on with that. For those that don't know, Pierre's been around the block for a couple of days now. He was one of the heads at Cyrus One, which was subsequently acquired by Blackstone, I believe. Is that correct?
KKR.
Who acquired
KKR and GIP.
Thank you. Sorry about that. Previously, he was at Spirit Realty, which was acquired by Realty Income way back when. And way back in the day was at Point 72. I'm sure you and Stevie, if anytime you need Mets tickets, it's just a phone call away and you got yourself some tickets. The next handful of slides are from their investor presentation. It does provide an overview on the company. Looking at some of the highlights, their key statistics here. We did talk about a couple of those stats. The key here is visibility, building brand through real estate, convenience and access, looking at growing demand drivers, and they talk about the strategic location of their properties. I think this is very interesting how it's, in versus not near a shopping center, and how important it is to be near a shopping center. And we see that every single day. They talk about how the assets and the frontage exposure here works as far as rent is concerned. Would love to get some of their comments versus their peers. And then we look at, obviously, the diversified portfolio, which is very key. And when you look at the lease maturity profile, I think it's something that jumps out because it seems like they have, frankly, with 11% coming due in 27, really the next big deal is, frankly, looking out past 2030. So strong renewal base here, looking at some of these slides. This is the sweet sauce. We're going to get into this as far as their deal-making prowess and what they're looking for, as well as the ideal portfolio composition. And we will talk about that. I think this is really interesting as well, this great slide in their presentation that talks about the top industries and concepts and their exposure. And, one real thing to take away here is we talk about the diversified portfolio, the average base rent for each of the tenants, frankly, is de minimis. They do note here that the top 6 industries represented here represent 2/3 of their base rent as of the third quarter. This is a very telling slide when we talk about the 37 states that they're invested in. Sure, because of Texas, they have a big exposure here in their backyard. But, obviously, very geographically footprint. When you guys are looking for a property manager in Hawaii, Pierre, you got my phone number. Happy to go beat boots on the ground. So let's turn off the slide here for a few minutes.
Yeah, maybe would it be helpful, Dave, that I kind of gave like a quick overview as well, just so you kind of see where we're at before we jump into Q&A?
Yeah, sure. I mean, again, because I had some of these set questions. If there's a topic you want to jump right into, we can go back to it and turn the slide on.
But yeah, I want to just kind of make sure the first thing is, we IPO'd a year ago. Like we had this company that's like frontage focused, as you can see in the slides, like very strong portfolio, very clean asset base. It's like we have this developer DNA, which you kind of highlighted in the slides, where it's been comprised of a very low rent, 8,000 square foot box, high visibility properties, which I think stacks up, as good, if not better than anybody else. And that diversification, that asset base is really strong. The balance sheet's in a great place. Very low levered at 5.3. We're fully funded now with the 75 million, which we can go into in your Q&A from the Maywin investment. And it's important to highlight that is a unique structure, which a lot of people have looked at, but I think it provides us with the capital to grow. The growth trajectory for our company is clear. I think there's a strategic advantage for being a small cap company in the net lease space, because with the guidance we provided of $100 million, like that is, growing the asset base 10%. We're going to grow just on that portfolio over 3% next year. We gave guidance for 2026. The valuation is clearly, in balance. Like if you think about the implied cap rate, there's a slide in our investor presentation. I believe it's slide 22, where we show that the cap rate is probably like low nines, maybe high eights. I don't think it's in this one, but the valuation is certainly very, very out of whack, where we have the potential to grow. And like that's the thing that gets us excited, is the ability to kind of go into this niche, real estate first focus, finding things with frontage. For me, as like a former buy side guy, I was a buy side guy for like a long time. I just think like the setup is like very interesting, because you have a stock that is very cheap on NAV basis, fully funded, great portfolio. People have been doing this for a long time. And the balance sheet and the new capital partner that came in that fully vetted the portfolio, sits on our board, knows what he's doing also is helpful. And so I think there's a lot of alignment between all of us to perform and show and grow this company in a meaningful way. So with that, I'm happy to open up to questions in terms of what you'd like to go over.
Well, you threw a lot out there to start, so I feel like there's so many things we could pick off of. But let's start with this first slide that's up here, because
Okay.
this is the core of what you guys are doing. How you focus on your prowess of acquisitions, dispositions, that frontage. Can you maybe talk about the developer DNA? Stephen, who's not on this conversation today, we have done a 5-and-5 interview with Stephen for those that are looking for a short interview with the CEO. But, walk us through, let's say, the DNA of FrontView. We could use this
Yeah.
slide as a starting point.
I think it's really important, and it's not like it's overlooked, but Stephen and the team here, I'm the newest member, but Stephen and the team here have been doing this for 25 years. Like Stephen's came from this company called North American Development Group, which was a large multi-billion-dollar developer of shopping centers. And he ran the Southeast for that company, and just did a lot of different shopping centers, and he's the one that came up with the outparcel strategy. He's the founder CEO. There's not many founder CEOs in net lease. I'd say that Joey Agri might be another one, where he knows every single property that came in here. And like, what does that translate to? It translates into like case examples of our assets are much lower rent base, our recapture history in terms of 105% recapture on the leases that expired. That's actually a very good stat. When things come out for expiration, we generally think it's a good thing. But it also means like we do almost in a way have lots of examples where we rework a tenant at higher rent. So examples of that is like we have a Wendy's at 110,000 in rent that we're going to convert into a Bank of America at 150, 160,000 in rent. Like recently we announced this Tricolor asset. The Tricolor caused a lot of problems for a lot of credits. We just released that property to Avis within a month. And that uptick in value is 124% of what or 24% higher in terms of what the value is just with that new lease that we got with Avis. We have a Caliber's Collision that we're turning into a Canes. And like that's another example. We have a Walgreens that's not even, the Walgreens hasn't even told us they're not going to renew, but just in case, we have Wawa lined up to just take that space if they want it. And they're already working through the entitlement and just getting that set. We have a Twin Peaks that we've converted into a Panda Express and a Jaggers. So that entire concept of reworking a property because of where it's located, because of the frontage nature, where we think that that is unique, and we do that more than the others. I know that there's a lot of ways to skin the cat in net lease, and I've seen it. A lot of people tend to just, if the tenant doesn't renew, they get rid of it. We tend to find a new person to take the space at higher rent. So if you look at the 49 leases that did not renew, that had renewals, several of them went to new tenants at 110% recapture. I mean, like that's a testament to just the basis that we look at. So we have a lot of properties. If you look at the page, I think it's slide 11 on what you have in front of you now, one more. So if you look at this slide, and you think about that lower left, that the one on the left, and it shows 200,000 in rent. If you think about what that means, if you have a box with frontage that's under $200,000 in rent, the amount of users that would take that space it's a large amount of users, and the rents are higher today. The replacement cost to find locations with frontage in these markets could range to $400,000 or $500,000 in annual rent if you want to build a new QSR, build a new box at those sites. I mean, that's where like the developer DNA comes into place, is understanding like what that asset can be, what that asset is worth. And credits can change. What Steve always mentions is that in shopping centers, he used to think about like Bed Bath and Beyond as like you get that anchor, you're golden. You get a Bed Bath and Beyond, you get other aspects. Bed Bath and Beyond is no longer here. That can happen, but if you have the right asset in place, it sort of doesn't matter who's there. And so we obviously have 95% of our credits are corporate credits, but we do care a lot more about the real estate and make sure that the basis and the real estate is in the right place. And that angle of sub $10 million acquisitions in those more fungible properties, it's a pretty wide lane. And as a small company, we continue to add and grow into that.
I just got excited when you started talking about Wawa. I'm hoping you're going to be able to bring Wawa to Texas here because I want to get some of those sandwiches if possible.
Yeah.
Here's that slide 11 that you were referring to, by the way.
Yeah.
So that's up on the screen. So, a lot of good stuff to go in here. You talk about being fully funded. And I don't think we had a thing in here about your debt stack necessarily, unless I missed it. But, talk about, let's say, we know about your ladder lease maturities, looking what that looks like down the road. What about the debt ladder? Because when people think about REITs and commercial real estate, oh, there's this wall of debt that's coming to. Oh my gosh, wall of debt. Like, what's your thoughts about debt maturities, especially in the chair that you sit in?
I'm not concerned about it. We have a very simple balance sheet. We have a revolver and a term loan, $250 million revolver. With an initial maturity in 27, but we can push that to 2029. And we have a term loan, $200 million, that is also 29 max maturity. Like we could easily get a new term loan. We could easily get more revolver capacity. We just don't need it. Like with the funding that we have in place, if you think about our guidance of $100 million of acquisitions in 2026, with $75 million being funded with the equity that we got through Maywin. We need $25 million of debt. So like we'll still be like less than 50% funded on the revolver, but we could easily add more term loan if we wanted to. I think that just given our size, we'll probably be in the term loan market for a little bit before you go into potentially private placement market. I know that our colleagues at NetStreet, they did a clever 7-year term loan, which is good. Usually, a term loan market's 5 years, but you could do 5-year term loan, you could do 7-year term loan, and then maybe you could go into private placements. And ultimately, where we like to be is like this. In this past quarter, we announced a couple amendments to both our credit facility and our term loan. And first, removing the adjustment to SOFR. So historically, when it went from LIBOR-based borrowing to SOFR-based borrowing, the banks are charged a 10 basis point premium. That's gone away this year. And so we actually got rid of that 10 basis points as well this quarter. And we also expanded our grid. So we were borrowing at 120 over SOFR. Now we're borrowing at 115 over SOFR because our LTV is below 35%. And so I like that. My entire view on leverage is that it's not super beneficial for REITs to be at all that much levered. Being sub 35% levered is a great place to be. One of the things as one of the happiest things I could say on the call was that we're at the lowest leverage since we went public because we're net disposers in the past 2 quarters, which is the right thing to do when your cost of capital isn't accretive to deploy. Now that we have capital in place, and we're ready we have a business plan that we think makes a lot of sense. I'm excited to do that. But when you think about buying $100 million with 75 million equity, 25 million debt, we're actually delevering next year. There'll be a little bit more leverage coming into the fourth quarter just because of our guidance on acquisition dispositions. But we anticipate that for 2026, leverage will stay very modest, certainly below 6 times, and that's a good place to be.
One thing that I guess, I don't know if you're looking at it, is the preferreds.
Yeah.
We've seen a couple of examples really in the past month of two or three, and I'm not counting your convertible, but like Global Medical and was it Alpine? Somebody else launched a preferred stock
Yeah.
offering, and it was successful. What's your thoughts about the preferred market these days?
Well, I think that this one was a bit special. Like, I think that the preferreds is great. I think there's a lot of people that are trying to put capital to work, and the preferreds allow people to write higher checks. And if the equity market isn't there, it is a good alternative for a lot of companies. So I applaud people being creative. I think that it's a good idea to become creative and to think about other ways to source capital. I think that the way that this preferred came in and this is all public, Charles came in first being like, I'm a big equity investor. He bought out the IPO. He's been adding to the investment. And he thought that having this sort of alignment and this preferred structure makes sense. And there's a lot of things about this preferred equity that is very unique in nature, but it allows us to treat it a lot more like equity in every way. And that's a bit different. Our rate, like compared to Pine, that they did a good job. Ours is 675. Theirs is 8. Like ours converts at 17. Theirs does not convert. Like we believe that this will convert to equity in 2 years when we have the ability to force convert it. And I think that that's will happen, and this will be the first slug to get us going. But I think it's important to you can always like wait for the capital markets to appreciate the story. But I think that this allows us to generate more cash flow per share, get the engine going, not dilute existing shareholders with an equity offering, issue equity at effectively 17, and then we can get it going, and hopefully that becomes the most expensive equity we issued, and we're off to the races.
And we'll come back to that because we've got a couple of things in that presentation to go through. You've been talking about this $100 million acquisition target, and also probably selling assets against that as well. So how do you think, let's say, big picture, in a perfect world, the stars are lined up? New, more dovish Fed chairperson, interest rate cuts, hopefully 10-year treasury goes down, which means your cost of borrow gets more attractive, dot, 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 dot. How do you think the acquisition disposition market landscape evolves in 2026 if those stars align?
I think, well, cap rates go down, right? So if you think about if you want to dispose, if you want to dispose of assets, it's a great market to dispose. If you want to buy assets, it's going to be harder to find. 7.5, 7.75, that probably comes in. You're talking about a tighter market. The value of the portfolio is more. So right now our assets are trading at a 9 cap. You could not buy any of these assets. I mean, we bought our below average properties. We sold about 10% of our company. We sold in the past year. Several properties at a 675. Like that is, and with the stock trading at a 9, it's the disconnect is meaningful. So I think that certainly comes in. But the dovish Fed and like the rates cutting helps, helps interest rates, right? Like you borrow, we still have some floating rate borrowing on a revolver, and like that will certainly help earnings and it will help boost growth. And I think that it'll help the sector. I think that the sector generally is pretty well set up from an interest rate cutting perspective, and there's less supply concerns like in other real estate subsectors. Like there's not a lot of drive around. You're not seeing new builds on outparcels. Like you're not seeing that. You're seeing the existing stuff being used, and it's because of construction costs are so massive that the replacement of an existing box costs a lot of money, like way more than just releasing an existing space. So for us that have those locations, I think that's pretty optimistic for rents continue to tick higher, where the underlying rent growth is there, plus the ability to potentially source more deals. What's nice about where we sit is like we don't need to do billions of acquisitions. Like we're doing, like you saw Realty announce this large acquisition, which I thought was like a very, like kudos to them, like very creative, very thoughtful deal. But it was $800, $900 million, and then moved AFFO up a penny. Like we can do a lot less, and move AFFO per share much more than that, just because of our size and just because of the area we're doing. So our $10 million deal, $15 million deal moves the needle because we're just a smaller company that's growing into the space. And so I'm excited about that opportunity in that macro setup.
I have a dumb question. I'm not the smartest tool in the shed, as I like to joke.
Well,
Is
you worked
there
at
an
Green Street for a while.
Sorry?
You did work at Green Street for a while, so I'm sure
As a
you sure
trader,
learned
not as
something.
an analyst, for the record.
Yeah.
Is there an opportunity, because you guys are out parcel specialists, to work with an existing shopping center REIT who's more focused, frankly, on the actual property, maybe than developing the out parcels? Just me shooting out loud here. Hey, Connor and Kimco, we want a JV with you on 75 of your shopping centers to be your out parcel developer, owner, operator, manager, 50-50 rev share. Is there an opportunity to work with some of the public REITs? Because, we talk about this parking conundrum because there's all this potential unused space at some of these properties. Is there an opportunity there?
I mean, those conversations are happening in terms of different, and it's not just public. You have big private companies that also have it, that own shopping centers and mall operators like Macerich has a ton of shopping centers that have out parcel space in front of it, and those lots are great. We did that with, like, we own the Walmart, and we built out parcels in front of the Walmart, and like that opportunity exists. Generally, JVs, I feel like JVs sometimes work, sometimes don't, but it gets a little complicated. I think that might be a bit farther down the road. For us right now, it's kind of execute and buy frontage, buy the 100 million, execute into the plan. But the landscape to kind of grow beyond that, once you get if you start to deploy more capital, there are a lot of things you can do around the shopping center, because I think that those assets, there's a lot of embedded value in the frontage. And that frontage opportunity, I think, is pretty attractive.
You briefly talked about the credit facility amendment. I don't mean to be the bearer of bad news, but we're done with 25. You know what I mean? Like, let's turn the page. I know you guys have some year-end type stuff, but frankly, we're turning the page to 26 now. So, what does the impact of this credit facility amendment look like next year? Oh, by the way, remember we talked about this new regime coming in on the Fed and all that other stuff. So, how do these potentially line up for you, and why did you pull that trigger when you did?
Well, yeah, I mean, like effectively the 15 basis points between the new grid that we got and getting rid of SOFR came into place in like one in November and one like October. So like, you're not going to show on call it 300 million of debt. You just save 15 basis point all of next year. And it's like that is like that helps next year. Like where there's a lot of different aspects that we're, as a small company that's trading below NAV, you have to be very mindful of every cost and understanding that if you're not getting platform value, you have to look at these things. So that is a big benefit going into that savings that goes into 26. Obviously, there's some floating rate component, but that's where it helps.
So we have spent a few minutes of this conversation talking about this Maywin transaction.
Yeah.
And I was on the road when I saw the press release, and I'm like, wait, is that who I think it is? Is that? And again, I go way, way back with Charles and know how well respected he is. And clearly, as you said, somebody who knows this business very, very well. And curious, let's say again, I don't know how much you could share, but like who approached whom, how did it kind of come together? I mentioned, you mentioned that he had owned the common, trying to get the interests aligned. Obviously, there's other partners that are part of this bigger picture as well. Um, it's a very unique transaction that we don't hear about typically in the REIT industry, these types of deals. Um, Walk us through a little bit more of that you haven't already shared with us.
Sure. So similarly, like I've known Charles for a long time from New York, and I mean he was worked at J.P. Morgan Asset Management, head of REITs, and he created this fund called V3, and it's basically V3 and Long Pond were like the two shops that kind of built out this niche, and he was an investor at Spirit when I was at Spirit, and he's like very thoughtful person and a great human being. So like that's a nice place to start. He was interested in FrontView before I joined. He liked the common. He was very much interested in this outparcel frontage strategy. When he bought a lot of the equity, he's in Dallas. He approached us. He approached Steve and me. I happen to be a neighbor with him, so I see him a lot. And he basically said, "Look, I'm into this common. What are different things that we could do?" And we talked about. It was a heavily negotiated deal, but a few months ago when we talked about doing a preferred equity investment, we discussed it. We engaged our advisors. So we worked with J.P. Morgan, Morgan Stanley, and Wells Fargo to just analyze the deal and making sure that we got all the terms that were exactly in the interest to our shareholders. Where what I cared about was keeping it very simple, very aligned, no bells and whistles, no blockage rights, no governance restrictions, no make-whole provisions, and 100% treated like equity from an auditor's perspective. And so we were able to find all those terms to get it to work. And Charles raised the money, raised the different funds that support the investment. So in fact, if you look at the document, there's three funds that are in there. There's Maywin, and there's two others. One of it is BC Partners in Boston. Another one is a large family office. And introducing us to those relationship was helpful. And I thought that from a board perspective, he was actually being considered a board position before the Maywin offer, so there was alignment there. I thought that having him, and he did just like I expected he would, he did a thorough diligence on the properties. property by property on the business plan. And I thought having that third party take a look and validate that would be additive. And obviously, he knows people, I know people, and introducing us to different investors, introducing us to different thoughts around those aspects is helpful. So all of those things aligned, and when we looked at the terms that we got to, and we checked a lot of different ways, so 675 rate that converts to common at 17, that was effectively 30% premium of where the stock was trading. It's obviously come in. I think that makes sense, and he's fully on board to own the equity for a long time, because I think that he sees a lot of value in going to steal one from him. The way I thought about it, and I agree with it, is like the net lease is a marathon. If when we got out the gates with the IPO, a little bit stumbled to kind of get out the gates. We have a pair. We need, like, for example, you need new shoes. He's giving us new shoes to get going, and I think it's really important to get going to show that you can return, cash flow per share to your shareholders, and like that was the inspiration to kind of get it lined up. But we did look at other alternatives. We looked at other prefs. There were other people that were interested, but this was obviously like the best, economic deal, from governance, from all the different aspects of how this structure works, is completely not market, and like a very unique structure that benefits the shareholders.
So let's really start getting into the meat of this. What is the ups? And I have this and ask you this in a couple of different ways throughout the conversation, but what is the upside versus your peers? And you have this great chart in your presentation, slide 22, that kind of says, here's what sets us apart. And I was chatting with somebody yesterday who is very bullish on one of your peers that you mentioned, NetStreet.
Yeah.
They were all about NetStreet, and they provided a pretty compelling argument as to why. And I'm not trying to compare you versus NetStreet, Mr. Manheimer, if you're watching. But that being said, what is the value proposition here versus your peers?
Sure, sure. And like shout out to Mannheimer and Donlin, like they've done a fantastic job. And so we're both on McKinney Avenue in Dallas, so like we're the McKinney REITs, and happy for them. So I think that, and this slide, frankly, came from a slide that NetStreet had earlier, and it's this concept of like, where are we trading? Just like if you believe that the portfolio is good, where is this asset trading? So at right now, in the $15 range, you're probably in the high eights, and you think about the entire peer set trading roughly six and three quarters, are below medium average assets trading in the mid to high sixes. It's like you're trading at a pretty steep discount. I think we should probably added slide 23, but the other aspect, the next slide that follows this in our investor presentation, is that we're also smaller in size. So 100 to $200 million of acquisitions, if we could generate like 100 basis point spread to 150 basis point spread, like we will grow faster than anyone, just given the size. So if we can get to a NAV or a premium to NAV, like we will have the highest growth rate with not that large of an acquisitions, and it's part of the reason why I think that net lease as a sector within the REIT market is a good sector. Same with healthcare. It's because they trade at premiums to NAV most of the time. Today, 98% of like net lease REIT market cap is trading above NAV. So if you think about what does that mean, like it means it's different from multifamily. It's like different from other sectors that generally trade below NAV. If you're trading above NAV in your net lease REIT, you are crushing it in terms of like cash flow per share. And so like, that's what makes this unique setup, because being small is good, having a good portfolio is good, being funded is good. And I just think that the price is just irrationally low, probably from coming out of the IPO.
One quick side note, you talk about net lease. Going back to my Green Street days, it used to be those companies that were on that slide that we were just talking about. But now, when you think about how that sector has evolved, where again, I'm not calling out any companies, good, bad, ugly, but you have other net lease REITs that are out there that aren't in that bread and butter basket, such as Orion and net lease office properties, NLOP, Motive Industrial, that's net lease industrial, right? A lot of these other sectors seem like they have net lease players inside of it that, yeah, they're technically net lease, right? But like Motive gets bucketed in industrial. NLOP Orion got bucketed in office, but they really are net lease. So, I think when you really look at that pool, it's actually much bigger than what's really being presented on the surface. Again, not
Well, I
saying
mean,
good, bad,
not,
ugly.
not,
It's just, it's different from sector to sector, as you said.
well, I mean, even like, I mean, I was like prior here is at Cyrus One data centers, the leases are, 15 years with a AAA credit with bumps. I mean, it's sort of it has that same sort of feel. Obviously, there's power pass-throughs, but there's a lot of stuff that is actually net lease. But I think that the what makes FrontView unique within net lease is like one, you have a founder, like founder CEO, who's picked every property. Like this entire thing has been like really created. We have this frontage real estate first strategy, which I don't think any of our peers really. Most of it's credit focused. Ours is real estate focused with good credits, and we're of a smaller size, and like that's a unique advantage I think that we can offer to our investors.
So that leads to the next question about that frontage approach. And we talked about that geographic footprint across 37 states. If you had to look at the crystal ball 5 to 10 years down the road, does location matter as far as states and geography, or is it really the quality of the asset at the quality of location having that frontage visibility?
So I think we like lower tax states. So I could see us going farther. Like we're based in Dallas. I would be thrilled if Texas became the number one state over a period of time. I think that happens. We do have plenty of assets in the Midwest. Like the Midwest, there's some great suburban markets. What we look for when you pull up a property, like, for example, we have like this one concept, WSS, which people ask about. WSS is a Foot Locker brand. And I'd highlight that on our website. I think we are the only ones, maybe Agree does it too. We're the only ones that on our website will put 100% of our properties. So you can actually say, hey, I want to look at this one property. So we have a WSS in Mesa, Arizona, and you pull up that property in Google, and you can just see, the super centers all around it, like all the Chick-fil-A's, all the stuff right next to it. And you have this one property there, and that's kind of how we look at every property. It's like, how's it situated? What's the market around it? But then we do pay attention to taxes and the ability, if things go wrong in Texas, like our ability to get at the property and take it back and release it to someone else quickly is like 10 days. It's a little bit different if you're dealing with New Jersey. So like you have to think about, what is the downside case and our ability to get access to the property. And so I think that drives some of our disposition decisions. So we sold close to $80 million we're going to sell this year. That is like, if you look at the composition of that, it's really low cap rates, but it's also in some of these markets that are like a little bit tougher from a tax perspective. And so it's something of consideration for us.
You talked about the tricolor deal and how quickly you were able to release that space. And so it leads to my question about the diverse tenant base. How does that diverse tenant base benefit investors who don't think about this stuff on a day-to-day basis like you do?
I mean, I think diversity is huge. Like diversity is like we probably have one of the lowest top tenant, lowest top 10, lowest top 20. We're the only ones that actually show top 60 ABR, and I would encourage people not to look at the top 40, but look at 40 through 60, and you'll see like, oh, there's a Starbucks, 7-Eleven. It doesn't get worse. It's just a very good concept, but nothing is big. And like I think that is a benefit. But if you also look on that page, you can see that we're missing a lot of concepts that a lot of our peers own. For example, like we don't own a Home Depot. Like we own a Lowe's, but we could add, we don't own a Dick's. Like we don't own other aspects or other assets that could have frontage for us. And I think that that diversification, we're the same top 10 as Realty Income with a much smaller base. And it produces, it's where nothing really is a big problem. And we can obviously, with our basis in good real estate, when things go, when a tenant has an issue, the fact that you're able to re-tenant it and recover more than your basis is something that's pretty unique. Like the tricolor thing is super interesting because of the amount of people and secured debt that got on a fraud, an alleged fraud. It was a big deal. For us to have so many different offers around lease, multiple sales, we ended up with Avis that quickly, is really just incredible. I think that Avis looked at the entire portfolio of tricolors and picked 3 properties that they wanted, and it's like our property because it's just good real estate underwriting, Marietta. And like that's something that is, like I think if there's one thing I want people to take away is that the portfolio is very good, and the strategy is real estate first focused strategy with credits, and there's a lot of room to execute in that strategy.
You guys are, I don't know if conservative is the right word. You paid a 21.5 cent dividend looking at the last release here, 6.3% dividend yield, but you note a 67% AFFO payout ratio.
Yeah.
So for investors who are concerned about dividends with REITs, because that's what I talk about a lot is the importance of dividends, what would you share with that investor about your dividend coverage and safety?
So I think being below 70, 66 is a very, very good, healthy coverage ratio. I think we're below a lot of our peers. And I'd say that on top of that, our loan to value is below 35%. We're at 5.3 debt to EBITDA. It's a very safe dividend. And just my entire view is that you want to reduce perceived risk, and the dividend and having a low payout ratio is the best place to be. And so I feel like that is a comfortable place to be. And I think that obviously I'd love to raise the dividend, but you have to raise the dividend through earnings and earnings per share growth. But I think that right now we're very happy with that. And I think that with the new equity capital that we got, like we're very well positioned to grow that dividend as our AFFO per share grows.
Thinking old school in the back of my head, I've got Mike Kirby and John Fosheim talking to me right now,
Yeah.
talking about how important it is for low leverage, sub 50%, if not low, underpay your dividend so that you're not putting yourself in jeopardy. Like literally,
Pre-fund your
I've got my
equity,
20 years
like
ago hat in the back of
yeah.
my head talking right now.
No, it's I've learned a lot around it. Like I was at, I was at 0.72 for 7 years covering REITs. It's like low leverage helps. Like if you get over your skis, it's kind of like you're walking down the plank, and like your options become very limited. And so you want to stay low levered, and you want to have a very like low payout ratio, and yeah, like I could be earning more. I could buy more with leverage easily. Don't want to do it. We're funding. You talk about 100 million of assets. That's a 25% LTV on acquisitions. Milton Cooper from Kimco, he used to aspire to get to 25% leverage on his acquisitions. Most REITs do 35 to 40. And so I like the fact that if this capital, we're actually using less leverage than we could. And like that's kind of baked into our guidance, and like that's something that I think improves the safety of the cash flows.
Now, this might be a difficult question to answer because you have so many different types of tenants spanning across everything. How do tariffs potentially impact you guys and or your tenants?
So I think like from where I see it, the way that tariffs are, first off, the biggest place they're impacting is in new construction. Like the amount it costs to build a new QSR is like we're looking at new construction Wendy's, and the new construction Wendy's, which is actually not even the best of the QSRs, they're charging 500,000-600,000 in rent to finance a sale leaseback of that. We have Wendy's that are 110,000 in rent, and so it kind of makes existing locations worth a little bit more because building new ones are extremely expensive. And so I think it just kind of gets to that like replacement cost is where I see like for us the biggest impact. As far as our tenants, like we haven't seen really many issues on that front in terms of tariffs affecting a lot of our boxes being smaller. They're service oriented. They're not as impacted by that service or necessity, and they're not as impacted by it from what we've seen.
So, besides waiting for that specs scotch bottle drop at midnight or your hook slice issue on the golf course, what keeps you up at night these days?
I mean, I think right now I'm just excited to execute this thing. Like I think that what keeps me up at night is I've seen very successful stories in the net lease space in terms of companies that have grown and developed. I mean, I like kudos to Agree, like in terms of what he had to deal with to he had a big Borders and Kmart and all this exposure. He was a 200 million market cap company when he started and kind of created that. Same sort of DNA as Steve, with just kind of building a shopping center, lived it with those life. His father kind of was also, a big developer. And like that is for me, what keeps me up at night is like how do we execute on what's ahead of us and doing the best deals to kind of stay within this lane that we think is pretty wide open.
We have a good question here from one of the attendees who says the capital deployment plan for 26 is smaller, 100 million versus 125 and 25 at lower cap rates, 7.25 from 7.9 year to date. Is that reflective of the pipeline being smaller and or competitive, or is the pipeline and capital constraining factor on what the business will be able to acquire next year?
So that's a great question. So the reason that the capital came down to 100 million has nothing to do with like what's available. It has nothing to do with we could easily increase that. It has to do with the equity that I was able to raise. So we were able to raise. So we were able to raise 75 million of equity to do 100 million of assets of acquisitions. That's assuming 25% leverage. If we were able to raise more equity at attractive prices where it makes sense, we could easily increase that meaningfully. We've talked about cap rates going down. 7.5 was a cap rate in the last quarter. Most of our pipeline right now is anywhere between 7.25 to 7.75, but just we're not sure on our guidance. To be conservative, we pushed 7.25. We do think cap rates are coming in from 7.5, what we've talked about. But I think that the real reason for the guide, the size, is just the equity capital we secured funded.
So we're calling the bench. We're bringing in
Okay.
Mariano Rivera for the close. Teed it up. Here you go. Why FrontView? What is the value proposition in 26 and beyond?
Sure. I mean, three things. It's a great portfolio. It's fully funded and like vetted by a third party. And we can grow faster than peers if we're given a good cost of capital. And I guess the fourth is we're trading at a meaningful discount to NAV at a very high implied cap rate. So I think if you own the shares, you have the cushion of the portfolio, you have oversight, and you have management team that's 100% dedicated to it, highly aligned. And I think that opportunity to just get back to NAV and then to grow it is meaningful. And so that's the reason I would take a look at the shares.
Well, Pierre, I look forward to seeing you here down the road next week at NAREIT with all of our fund industry peers on the buy side and sell side. And I hope that if we get to do this again, December 4th of 2026,
Perfect.
exactly a year to the day to see How has the stock played out? How is the portfolio transition? Are there more opportunities that are out there? More importantly, what are the peers doing? Like, what does that mean across the landscape? Do we see consolidation, M&A, more unique cap raising structures that you're talking about? Really pivotal time in our industry. And I'm really appreciative to get some time from you today for you to share your thoughts about potentially what's ahead in the near future. So, on behalf of everybody, thank you so much.
Perfect. Now, thank you, David. I look forward to seeing you next week.
Thanks, Pierre.
Take care.
Bye.